Good afternoon, everybody. Welcome back to the Schwab Coaching Channel. Our next topic is getting started with stock investing, and I am your host, Kevin Horner. Today, we're going to be taking a slightly different approach to what we've been doing in this class. We've been spending our time kind of familiarizing ourselves with many of the terminology, details, and understanding of basic concepts of investing, overall fundamental analysis, trend analysis, and so on. But today, we are going to start building a new portfolio of equities that we're going to monitor in this class going forward. We're going to keep an eye on them every week. We're going to start with a specific balance of investment dollars, and we're going to start buying up stock in groups of the market to kind of match and mirror what a long-range investor might consider doing. So I'm going to provide for you some steps along the way. And to do that, we're going to incorporate both the Thinkorswim desktop application today, but we're also going to spend a few minutes in the Schwab.com website working through our portfolio checkup tool. It's a nice opportunity for you to keep an eye on your long-range portfolio. We provide you with reminders that you can utilize to rebalance as necessary, but really it's a framework by which you can not just invest, but give yourself something to base your view on, meaning an objective viewpoint of how your portfolio has been doing relative to benchmarks. And so I'm going to highlight some of that with us here today in the class. So that's the plan as we have it. I will be joined by, I believe, Mike Fairborn in chat at some point here in the near future. So he'll be able to get to things that I'm unable to get to in the chat, but I'll be keeping an eye on it for y'all. So don't hesitate to post in there for the duration. So let's cover our disclosures and then we'll get down to business. So remember that our conversation is exclusively for your information and your education, not here to make any recommendations nor endorsements for a particular approach or strategy. I'll try to remind you all of that as we work through today's class. Additionally, the concept that we're talking about, we will incorporate some technical analysis briefly, but we're also going to be talking about fundamentals a little bit here as well. But more than anything, like I said, an example of how some investors may choose to go about taking advantage of a weak market in the short term here. We've certainly seen some pullbacks, and we'll highlight that with the trend analysis and when I pull up Thinkorswim here in just a moment. So instead of going through some slides today, and talking about, understanding what stocks are, how do we go through this process, let's start with the understanding of where we are in the market and what we are paying attention to. So I'm bringing in Thinkorswim here, and we've got that S&P 500 look. Now, the thing that I believe a lot of you are probably going to point out is that we are remaining in a bit of a downtrend here. We've got those lows that we achieved last about 2 weeks back, that is, at 48.35, retreating to my green lines, 2 green lines there that are separate in nature. And you will only see how valid they are as we pull back on the time frame here. So if one thing I'll make note of before we move off of the daily chart, I just want to point out that we are in that series of lower highs along the way, right? And those lower highs followed by lower lows is how we define a downtrend. So that's what we've got working here. Now, we do admittedly, we've got this ultimate short-term low down here, and it's unclear whether that is the low of this drawdown or just a low within a longer range downtrend. So that's what remains to be seen. But if we're talking about probabilities, many traders will tell you they don't like the fact that we've, to this point, made yet again another lower high than the last one, lower than the last one, and so on, and have not given us a chance for a higher low. The first thing we need from a trend analysis standpoint is a higher low that will allow us to suggest that we might then have a new short-term uptrend in place. Now, it is true that we are up from the lows here, but by virtue of the fact that we have not made a new higher high yet, many would suggest that we are more likely, again, remembering probabilities, never certainties here, we might be more likely to revisit 48.35 for another test of support than we are to perhaps break through immediately. But all of that remains to be seen over the coming days and weeks. Maybe even this final hour of the market on a shortened holiday market week. We are closed tomorrow, so we're going to have 3 full days of no market action. And the market, sometimes traders get a little uncomfortable holding either long or short into a long weekend like that. It could be difficult depending on what, if any, kind of commentary we receive this weekend. So still a little difficult to discern exactly where we are in the longer range trend. Now, I'm going to pull this back to a weekly and mention that green upsloping line goes all the way back to our COVID bottom, everybody. So that's this. And we have seen this trend line maintained along the way. We pulled back here. We did it again. Whoops, I want to duplicate that oval once more. We got one right about here. Put another one right about here. And so what we've got is a very clear uptrend and yet again another test. So if you're wondering, Kevin, we've been under a pretty good amount of stress. I'm not sure why you would suggest that maybe we can continue the uptrend. Well, I think that those traders who are thinking that this is a perfectly appropriate pullback in a long range view, they wouldn't be wrong. Even at our lows, sure, we were down a fair bit, percentage wise, but nothing out of the ordinary for what many traders will tell you is a fairly standardized pullback, right? So if we put that detail in here, we're at our peak to our absolute bottom, right around 21%. Okay, so that falls in line with many standard pullbacks in the process, right? So it makes sense as to why some traders would look to position themselves here and take advantage of any price action nearer that 5,000 down to 4,800 level. Of course, it is always difficult to know. We don't know if we're going to just meander through here, if we're going to break that downtrend line and just get right back in gear, or if we need to retest. We really don't know. But we remain down a fair amount from the original, take my trend line here, from the original sell-off. And if we are residing right now at right around 53, we're still down about 13.5%. So some investors might use this, this last couple of weeks as a way to deploy some funds. Okay, so there is a very brief review of how the S&P looks right here. We ultimately, from the technical analysis perspective, as of yet, don't have a reason to get much more bearish until we see a price that takes us on a closing weekly basis under 4,800. Things get a bunch more dicey. Of course, we've got about 500 points of wiggle room to that extent. That would be, about right around 9% or so lower for a potential test. But only under 48, I think, would bears really start to feel very confident and bulls very uncomfortable. So if you were one of those investors who've maybe been sitting on cash and are waiting for reasons to deploy, you might have been pleased with the drawdown we've had in the S&P and the broader indices. The NASDAQ 100 has made moves similar, if not a little bit more weak than the S&P 500. Russell 2000 has been a bunch more weak than both the NASDAQ 100 and the S&P 500. But if you were one of these individuals who was going to utilize this weakness to start deploying funds, we're going to go through some steps that could be helpful. So one quick fix that you can always do is just click schwab.com, and that's going to get you right in to the schwab.com homepage. And I'm going to pull up my page here, and we're going to go down to under the accounts tab, the navigation at the top, slide over to the right to portfolio performance. Now you're probably going to see I have nothing going on here. Okay, no dollars spent as of yet. We're going to go to, however, from portfolio performance, go to portfolio checkup. So this is the tool that I was referring to as we introed the show today. And what we're going to do is establish a portfolio for this single account recognize you can do this with multiple accounts, of course, here on this page, but I'm just going to title this class title. So getting started with stock investing. That'll make this easy for me. Now, this is where you are going to work through a process to define our risk tolerance. Now, this, everybody, is a very big part of the conversation if you're trying to decide just exactly how aggressive you really are or how conservative you ought to be. So we have two choices to work through here. First one I'm going to show you is the profile table, just to highlight what it entails. So the profile table allows us just a more analytical viewpoint. Come with me as I scroll down the page here. We're going to see at the very top, we've got total return for conservative investment with taxable bonds. So as you're going through this, if you're utilizing this tool to not only build your allocated portfolio, but to monitor it, recognize that there is a conservative with taxable bonds, moderate conservative with taxable bonds, total moderate, moderate with taxable, and then we keep on moving down the line. Now, there are options available for tax-free investments as well, but just know that what we're looking at here are specifically with taxable, okay? Now, up at the top, if you were working with a brokerage account in lieu of a retirement, you might prefer municipal bonds, which could be, of course, free of income tax. And then you might want to lean that direction. So you would just click here for the municipals. Of course, if you're doing this in a retirement account, the taxability of the bond is less relevant to you because you're only taxed as you withdraw the assets from your retirement rather than when you are earning income from them. So IRA, you can lean towards taxable bonds, and brokerage assets. If you are benefiting from tax-free income, then you might lean towards municipals. So as far as this breakdown, though, let me just give you, we're going to go to the one that I am most likely going to lean into for our discussion, and that's going to be the moderately aggressive with taxable bonds. And the thing I just want to point out here, everybody, is that if you are the individual who is more going to look at the breakdown in terms of percentages and then the average returns that we're highlighting here, well, this might be all you need. And I put myself in this class. You certainly could go through the questionnaire that I'm going to show you in just a moment. But I think if numbers are what help you make your decisions, you might find that this investor profile table is all you need. It's going to give you the average annual return alongside your best case year and your worst case year. Now, I know it's easy to lean into the best case. I'm going to encourage you to lean into the worst case year and further probably lean into your worst case and add another 10%. Not to suggest that your worst case would go 38%, but rather worst year has been 28% in this window of time. And I'm just going to suggest you kick that up a little bit, right? The reason being, in my experience and the many, many conversations I've had with investors over the years, we all think that we can manage our risk to a certain level. And inevitably, we put ourselves in those investable assets that match that plan. And then the risk actually comes to bear in the form of market movement. And suddenly we're less comfortable. So I always encourage you to think that things can be worse than what the historical detail is, because guess what? It can. At any moment, it can be worse than what historical numbers suggest. So we always have to take that approach, and I would encourage you to lean more towards conservative, regardless of how you feel as you're working through these numbers and defining your plan, defining your process. The big takeaway for many of us when we start thinking about just how aggressive we want to be building a portfolio, it likely comes down to the amount of time remaining to you requiring or needing these assets. If you are in your 40s and your expectation is to work into your 60s and you're working in a retirement account, you know what? You can afford in most cases to be more aggressive simply because you have time on your side. That's one of the key factors. In fact, a very important factor is the amount of time. That can have a lot of impact in deciding just how aggressive you want to be. So Profile questionnaire, very basic, or excuse me, profile table, very basic. However, we could also do the investor questionnaire. And what I find really nice about this, everybody, is that you can just, if you've never really conceived of what matters and what doesn't, this questionnaire will take you through that, and it will help you to define things. And I'll tell you, when you start looking at things like willingness to take risk on, this is where it becomes very important. Again, assuming that you began your portfolio with that $100,000 of hypothetical investment, and then suddenly your balance is at 77.5, are you going to be comfy with that? These are the questions you need to ask yourself. And I cannot say it again without just reiterating it. Always think it can get worse than what is stated here. Okay. And that's just a common thing. We have to be comfortable with the risk we're taking on. And again, time might have a lot to do with your tolerance and comfort for risk. So you go through this whole thing, and at the end of it all, we go ahead and hit submit. And then the system tells us, well, based on your answers to this questionnaire, we find that you should fall in the moderate or moderate aggressive or wherever it is based on your answers exclusively. Okay. So for our purposes, I'm going to go ahead and back to the table questionnaire, the profile questionnaire. I'm going to hit total return, moderately aggressive. As you can see, heavy allocation to US stocks, almost equally heavy into international stocks as well, and then a chunk for fixed income. Okay. Now, we're not going to utilize the fixed income for this discussion. What we are going to lean into are the US stocks today, large cap, small cap, and then potentially the REITs, which are going to make up a very limited portion there, about 2%. So from here, now that I've designated that, I'm going to hit the submit button, I think, right here. There we go. So now my table is built, and I know exactly how I'm going to want to proceed. And I'm going to hit save and continue. And as you can see, this is my target, right? Now, the cool thing is we can have this up simultaneously to working in Thinkorswim. And what I want to do next is move off of asset allocation. And let me just define this briefly, everybody. Remember that asset allocation is talking about the components developed for underlying large cap stock, essentially, right? Large cap equities, along with small cap and international. Large cap, small cap, international, etc. That's essentially what we're talking about with asset allocation. When we start talking about sector diversification, though, that's where we're getting into our 11 sectors of the U.S. market. Okay, so the allocation of those funds, though, is going to be linked up with a modeled approach for the MSCI World Index. And so we want to essentially match, if we will, approximately those weightings. And so what we're going to do now is migrate on over to the Thinkorswim desktop, and we're going to start putting to work about half of my paper money portfolio of $100,000. And the reason is that, one, I want to get that money to work after having the market dropped a bit. And I also want to save some balance on sidelines because I want to be able to add to the portfolio as becomes appropriate, stocks that become interesting, maybe making new price level lows and things like that. That could be helpful for us. So one of the things we'll do here, we're going to go back into Thinkorswim. And I just want to give you all some very generic thoughts on how we could get started with this. We can actually begin with something as simple as a what about the heat map? Let's go in here to the visualize. We go to the heat map. We're in S&P 500, and let's go to technology. So now we're looking in infotech, right? One of the 11 sectors of the U.S. market, and you can see where our largest positions reside. Now today, because we are talking about simply working to meet what's happening here in our allocation model, we're not going to focus on some of the legwork that you all may want to be doing to ensure that you're buying up companies with proper balance sheets. So let me just say for 30 seconds that when you're thinking about building your portfolio, you may wish to do so based on a series of fundamental criteria that you've deemed to be appropriate for yourself. Don't necessarily take this fairly basic approach that I'm going to take today, which is to suggest that I want to have investment dollars in technology that's going to be approximately 20% of the overall investable assets in this portfolio, because that's about the allocation of the MSCI index, that is. So about 23% in technology and about 17 in financials, followed by healthcare, then industrials, then discretionary, and we work our way on down the line that way. So as an example, if I want to do $50,000 into, we're going to say, maybe as many as 10 different stocks, well, we probably don't want to exceed about 5,000 to any one position, right? So from a standard basic approach, we're going to pick on NVIDIA because simply it is down. It is off from its highs by about 25%, and it may represent an area for ownership. Again, I want to reiterate, this is not an encouragement or recommendation on NVIDIA in any way. And again, I want to encourage you to do some fundamental legwork that'll make you a little more comfortable in deciding just which investments you want to go with here. So we're going to do, let's see, out of our $100,000, that means we would hold no more than 23,000 in tech. Okay, but we also know we're not going to devote 100,000 today. We're only going to leave 50,000 in cash. So let's just think about everything in terms of about half. So if we want 23,000 in tech, we probably don't want to exceed about 10 there today. So let's just pick two of our favorites, so to speak, favorites from an example standpoint only, and we'll do NVIDIA for 5. And the other one, we could choose to pick on Microsoft. Microsoft got downgraded today. That might not be fantastic. We might put that one on a watch list for ourselves instead. But let's just look, because if the chart details are telling us there could be more downside, we'd like to make note of that and maybe buy it up at a better price if that's what we're thinking. So maybe we're patient on Microsoft, but let's do, for our example purposes here, NVIDIA, and see how Alphabet might look from this fundamental or this technical standpoint. Another one that's in that downtrend, not looking, the downtrend just as evidenced by the failure against the 20-day moving average. We can just keep it simple, right? We don't have to get cute. We just have a downtrend. That's all there is to it. So maybe that one's a bit more of a wait and see here on Alphabet. Let's go back to our visualize here. Yeah, maybe Adobe. Let's look there. That's in software. One of the things we can do here, if you left click, I'm telling it, I'm going to send it to my purple link. That way it's in the chart when I get there. There it is. Still in a downtrend itself, huh? Maybe even in a bit of a bear flag situation. Certainly at this point, price action not bullish here, unfortunately. So you might be stepping in. But if you're stepping in at this point, you might have said, hey, you know what? I do like the fact that we are off from our levels here. Let me... Yeah, 41%. Maybe some of you would say, boy, Kev, that is absolutely the kind of stock I'm looking for. One that is down 40% in the last year and off of its all-time highs, certainly well off of those levels. I mean, we're talking 700, basically 50% down from those all-time highs. So maybe an investor looks at this and says, I feel like this is, maybe valued appropriately. Again, I'm not defining that as such, everybody. So let's just go ahead and think of these two for our tech stocks today. We'll do NVIDIA, we'll do Adobe as our two examples for tech. So let's go ahead and step into both. I'm going to right click here And you'll notice that I'm just doing a standard buy because I don't want to incorporate any exit strategies here. We're allocating funds for the purpose of putting our dollars to work. And speaking of dollars, I'm going to make this really easy on myself, everybody. I'm just saying I want to buy $5,000 worth of this position, Adobe here. And I'm going to change from a limit order to a market order. And it's going to do the math for me. So $5,000 of Adobe at market. It's going to execute rather quickly, of course, since it's a market order, no guarantee of price. Let's go ahead and send it off. There it is. 14.2, well, 14 shares is what I should be doing. So let's see, trigger to buy. I'm wondering why it's not making the purchase. So let's just do this. I'm going to do the math on that, as it were, everybody. So we'll say 14 shares. Yeah, it doesn't let me buy the fractionals. So let's just say 14. There we go. 14 at market. So here's what we'll do. We'll cancel that one, and we'll just buy 14 Adobe at market. Yeah, just shy of $5,000 there, everybody. Actually, I think that math says, no. Well, what the heck. For 14 shares, and I like round figures, we're going to kick that up one extra share. 15 it is. Just a little bit past our $5,000 approximation, so there you go. All right, so there's Adobe. We have one position on, and now we'll go back to NVIDIA. All right, and we're trading just about 101 a share, so we can do about 50 shares here, everybody. So we'll just do that as well. 50 at market. Again, we don't want to encourage market orders because that can be a price that a market order can execute at any price, no matter what. You never know how quickly the market can move for you. So we're just a little more than 5,000 on NVIDIA, so 50 shares at market. So just as long as you're comfy with the price, go ahead and do the market order. But if you're worried in any way, shape, or form, I discourage market orders. Limits can be a better way to go if you're worried about the price you might be paying there. So be aware. All right, so there we go. 23,000 in tech to NVIDIA and Adobe. I should say actually about half of that, so about 10.5 total. And briefly, let me just go back over to my web page. We're going to go back to portfolio performance, and we should see these equities popping up for us when we get to, let me see if it's going to need that. No securities. Okay, so we're going to do this on an overnight basis, it looks like, because it's not going to take my individual purchases until we do an overnight batch, it looks like. So, all right, so we'll let that slide. Let's go back to Think or Swim, and let's pick on our next grouping. What do we say we do? Financials is the next leg in the MSCI breakdown. So financials come out to about 17%. And some of the names here. So we've got financial services, Visa and MasterCard. You've got your big banks, like JP Morgan, Goldman Sachs, etc. We might want to lean into something like a business, like a consumer finance. American Express tends to have a little bit more corporate relationship, say, than retail. That might be something for consideration. But let's pick on large company, essentially, here. We're going to go ahead and pick, since we needed 17,000, we'll pick 2 stocks here. And let's do about 4,000, 4,000 to 4,500 each for those. Now let's take a peek at maybe MasterCard. All right, so that's a little intriguing, right, everybody? I mean, we're there at the 200-day moving average. We're sitting on it. We had a very large breakdown here when the market broke down, of course, and now we've rallied back in, and some traders would tell you they're feeling good because we are right back up above the 200-day moving average and have held it for 4 closes in a row, assuming it closes there today. So maybe MasterCard. Let's see, Visa will probably look a little bit similar. That is a little bit similar, but also a fairly well-defined support that's about 10% down from where we are. Might need to give that one a little more room. I see Josh's request for Berkshire B could work out, but I'll tell you what, if I was going to be picky, I would much prefer, I think from the technical aspect, to be a buyer back when we tested the 200 there this month, a couple of weeks ago. I think a lot of traders would say if we could get in there, I feel more comfortable. Again, that's about 10% down. So we're maybe admitting that we don't want to pick on one of these if it's not quite at an area of support. As usual, have a feel for how you want to approach that, everybody. Let's look at some of those banks. How about JP Morgan? Okay, so maybe we're back to the 200-day. Are there reasons for potential concern as it relates to the trend here, everybody? Possibly, right? Because again, we sold down, we made a lower low, or at least a matching low, some would say. Let's see how this lines up. Pretty close to that, right? And we've kind of struggled at the 200. I could certainly see some people suggesting that. Yeah, you're right, Josh. Berkshire has a massive cash position. The question I have is, and this is perhaps a good thing, obviously, for the company itself, but are they going to deploy that money after a, limited pullback? Some would say that, Mr. Buffett was building that cash not for a 20% S&P 500 pullback, but maybe something even more substantial than that. Certainly, they're not going to be hurt necessarily by maintaining a large cash position. So maybe Berkshire is one of them. In fact, I'm willing to go with it. I mean, I'm a little democratic here on this show. I don't mind working with other ideas. Let's go ahead. Let's do it. Let's see. Quick math says if we wanted about 4,500 on Berkshire and the last trade is around 521, we're looking at 8 shares. So we can do that. We'll buy 8 shares total. Not a lot, but enough. Remember, our concern is not anything other than allocating our funds to the groups and categories of the market we want to expose money to. Now that 8 or 7, I'm going to go a little higher. We're going to go up to 9. Let's see here, 42. That's better. Yeah, I probably could get to a full 10 shares, but let's keep it at 9 for our purposes. So we'll pick up 9 Berkshire B shares here at market. Again, just gaining execution. We're not concerned about the actual price. And there we go. And then one more. Let's see. We looked at JP and we got Goldman. The biggest difference here is just the fact that Goldman remains below the 200-day moving average while JP Morgan is there at the 200-day, kind of fighting it out and trying to set that new level. So perhaps we can go with JP Morgan here. That looks to me to be about probably like 15 to 17 shares, somewhere in there. And that'll give us an appropriate allocation here. So let's see how 15 looks. A little light, so let's kick that up. Remember, we're trying to get to right around 4,000. I guess I'm going to have to go all the way to 20 here. So 20 is going to put us at 42. Perfect. Right in line with our Berkshire B there, right? So let's go ahead and do that. 20 at market, as I said. There we go. All right. So, hey, I don't know how you're feeling, but I love deploying money. I love placing trades. We're getting some money invested and allocated to the groups of the portfolio. Okay, after financials, everybody, what about healthcare? About 11% in healthcare. Ooh, now I know one of those got absolutely hammered today, this week, and certainly today, United Health. Let's take a look here. Actually, I think that was yesterday. My days are running together. Nope, it was today. So some of you might say, Kev, that is the move I was waiting on. I would like to deploy money into United Health. Well, I wouldn't discourage that. However, if I'm a buyer and I like to buy depressed assets, I still want to see the selling lose steam. I want to see the selling come to an end before buying. That low that we made back here at 438.5, that could be the level. Maybe it trades through that level. Let's see this on a weekly chart. Lots of action there, right? My point is simple. I wouldn't mind being a buyer here, but I don't have full comfort that the selling has run its course. So let's give it some time. We'll keep United Health on a watch list, essentially, give us something to consider. But for now, let's move off of United Health. Let's go back to this one. Let's hit up Lilly. Lilly had a nice day today, very green on the screen, as you can see, bouncing off of what could be considered a long-term zone of support. And some traders would feel confident by such a move. You might have a little bit of a little more chop, a little more back and forth on Lilly, but for our purposes here, that could absolutely work. We probably don't want to exceed 5 shares of Lilly based on price action here. About 5 shares would be $4,200 worth, and that would give us, exposure to about half of what we want. So we could go with that, and then we'll have to move off of healthcare because we don't want to put to work too much more than that at this point. So let's go ahead and buy 5 of Eli Lilly. And again at market, there we go. 4,200. Great. That's a pretty good number for us, it looks like. So we're all in the right frame of mind here. Ooh, Josh, I like the way you're thinking. What is it about Pfizer that's so attractive to you? I'll bet I know. It certainly doesn't look like the price action, right? I'd venture to guess it might be this. Oh, is it that 7.75% dividend yield? Yeah, I could see that working out. In fact, given that we have a group of or discussion in this class around dividends and the importance of dividends, we could absolutely consider Pfizer here. Why not? Let's go ahead and put a small investment of maybe 100 shares, $2,200. It's a little more exposure, but remind ourselves of what groups may lead the market during difficult windows of time. When we are led commonly in bearish markets, led by healthcare, led by real estate, led by utilities, those, sorry for the term, but less sexy groups, right? Groups that people don't necessarily want to trade, but want to hold and maintain. Now, one cautionary note, we don't know. We have no guarantee that Pfizer will maintain this dividend. But if they do, 7.75% is pretty good rate of return. So we'll consider that. Let's go ahead and put ourselves in a position of 100 shares. And then I'm going to show you one other thing that we need to make note of, depending on your preference there, as it relates to the dividend. So buying up just 100 shares of Pfizer in our example portfolio, give us something to monitor going forward. And hopefully that'll continue to yield that same dividend payout, because 7.75%, that's almost, that's just shy of double what the 10-year yield is, the risk-free rate of return on a treasury. So really, really interesting if it can continue to maintain that yield. So that gives us tech, that gives us financials, that gives us healthcare. So let's take a breather. Since we are running short of time today, in advance, I'll say I'm sorry that my conversation is running its course, and we are not going to have ample time to do everything I wanted to get to. But I do want to take a look at our newly developed monitor tab as a result. All of our purchases, now not everything is in here. So what I'm going to do, I've got a bunch of stuff that I cleaned out, went to a brand new overall invested portfolio, right? So what I want to do here is I'm going to make a quick change to my my groups. And I'm going to group everything by sector allocation. There we go. And so now, everybody, you can see I've got my industrials. I have had Honeywell. That's going to leave. All right. We've got some discretionary we don't need to worry about. We haven't put those in. We do have, though, our healthcare. Here's our healthcare positions, our financials, and our tech right here. All right. And then these others, I expect that we're going to see these fall off over the coming weeks. But, the diversification here, great reminder that you can allow Thinkorswim to do this for you, break it down into the sectors themselves. Now, let's jump back to Schwab.com, because we need to make note on that Pfizer position. All right. Oh, no. Well, here's what I need to show. So let me highlight this, everybody. Apparently, my trades in Thinkorswim are not going to conveniently migrate into Schwab.com. So that means I have a limitation, and I'll apologize in advance. But for those of you who are interested in that Pfizer, and let's say you're building your portfolio of dividend-paying stocks, remember that you need to come to the reinvest column here on your positions detail in Schwab.com. It's going to say yes or no. If it says no, and you want the dividends to be reinvested all the time, spending those dividends to buy more fractional shares, change from no to yes. By just clicking the word no, you'll get a brief dialog box that'll pop up for you, and it'll offer you the opportunity to say yes to that instead. Okay? Now, what I really think where we have the chance moving forward in this class to take advantage of things is to keep an eye on our monitored portfolio and continue to look for reasons and ways to invest additional funds to the overall allocation model we are striving for. Today, as we look at the account breakdown, we've put together today 26,000 in market value. We did about half of what I wanted to deploy today. I wanted to get up to 50, but we're just not going to have ample amount of time. But I wanted to give you a process by which you might consider getting started. Again, none of the stocks we've selected today were selected for anything other than an example. We did not look at fundamentals. It is something you might consider for yourself when you're giving thought to just how you're going to deploy these funds for yourself. But the idea that I want to leave you with, if you're feeling today as though you're hamstrung, meaning, the market's doing what the market's doing, you're uncomfortable, you've been sitting on cash, maybe you're a little paralyzed, I will just say the right time to be properly allocated as it relates to being in the market and participating in the market from a long-term viewpoint, the right time to be properly allocated and diversified is yesterday. Okay, so I recognize some of you might be concerned, but never feel like you have to get started whole hog, right? If you're sitting on a balance of cash and you're thinking that now might be the time, we'll start small. Nothing wrong with starting small. Take a 10% of your cash. Take 20% of your cash. Whatever percentage of your cash that you are comfortable deploying at any given moment, and just get started. I can't implore you enough to do that. The sooner you get the ball rolling, the better you're going to be. And defining your process, defining your plan, and giving yourself what I like to call that playbook to your long-term viewpoint, that is what's going to make your decision-making process easy on a day-to-day basis. And then, days where the market's moving and you're having those very awful, uncomfortable sell-offs, those aren't days where you're going to sweat it because you've got the plan. And what you're going to look at is your playbook, and you're going to say, I wrote down that when the market underwent one of those pullbacks, those big sell-off moves, I'm going to go shopping, and I'm going to go shopping for stock A or stock B from my list. Build that list today. Now is the time to do those steps and be prepared. Then when the market gives you those opportunities, you are ready to pounce on them. So that's really the plan that I would love to see you kind of incorporate. Remember, the plan itself is my encouragement. How you define those steps within the plan, that is all personal, right? That all comes down to your comfort for risk, your tolerance for risk, and so on. Keep that in mind, everybody. So with that, let's go ahead and wrap it up. Big thanks to Mr. Fairborn there in the chat, and bigger thanks to all of you because you some very nice comments in the discussions today. And I'm hopeful as we go forward, we're going to look at this next week and thereafter. We're going to continue to look at the allocated portion of our funds, look for opportunities to deploy new dollars here as well, and give us something to kind of track and monitor along the way. Remember, the returns are great, but really what we're looking for is the diversification of assets amongst and within these classes and groups. That's the most important thing. So with that, thanks for being here. Follow Mike and me on X at Mike Fairborn CS, at Kevin Horner CS, and hit that thumbs up button for me down below, everybody. We're going to get this out to the archives ASAP for all of you. So thanks for being here. Remember, tomorrow we are market closed, and Schwab YouTube channel is non-streaming tomorrow, so use your opportunity to dive into the archives, everybody. Thanks for being here. Have a great long weekend, everybody. I look forward to seeing you all again real soon.